Welcome to this deep dive, where we're extracting the core intelligence from a really important earnings call.
Yeah, today we are zeroing in on RV Group, that's REVG. We're covering their Q4 and full year 2025 results.
And this isn't just about the numbers. Our mission here is to really analyze how their big operational turnaround has held up.
Especially with that massive Terex merger looming on the horizon. I mean, this is sort of the last clean look we get at the company as a standalone.
Absolutely. And the market sent a signal, a very loud one. The results hit the pre-market, and the stock it rallied, up nearly 6% on some pretty heavy volume.
Which tells you investors saw what they needed to see. They saw real validation of the whole long-term strategic plan. This wasn't just a slight beat, it was a confirmation.
Okay, so let's unpack the numbers that drove that reaction. Let's start with the bottom line.
All right. The company delivered adjusted EPS of 83 cents.
83 cents. And the consensus was what, around 78?
Yeah, 78 cents. So a decisive beat there. And a huge jump from the 51 cents they did in the same quarter last year. Real growth.
And that came on some impressive top-line numbers too, right?
It did. Net sales came in at $664.4 million. Consensus was, somewhere in that 647 million range.
So a solid beat on both. But here's where we need to pivot from what they earned to how they earned it. That revenue growth, what's the real story there?
Well, on the surface, revenue was up about 11% year over year. But you have to remember, they got out of that lower margin bus business.
Right.
So if you adjust for that, the core business growth was actually closer to 13%. But I mean, the real engine behind the stock move was the margin.
Some margin expansion.
The Q4 adjusted EBITDA margin hit 10.5%.
Okay, and for you listening who might not follow REVG every single day, why is that specific number, that 10.5%, so critical?
Because it's a number they weren't supposed to hit for another 3 years. Their own long-term target was 10 to 12% by fiscal year 2027.
So they hit the low end of their 2027 target in 2025.
3 years early. It provides material validation. It means they've really changed the operating profile of the company. That's huge heading into the Terex deal.
So this is where it gets really interesting for me. The mechanics behind that margin improvement, the cash generation, the CEO, Mark Skonieczny, he called FY25 a year of significant operational, financial, and organizational change.
And the full year numbers just back that up completely. I mean, adjusted EBITDA for the full year was up 41%, to $229.5 million.
And the consolidated margin improved by 280 basis points. Let's translate that. That's almost a 3% jump in efficiency.
Exactly. In plain English, they made almost 3 cents more profit on every single dollar of sales this year compared to last year.
And that kind of efficiency, it just flows right to the bottom line.
It flows right into cash. They delivered a record $190 million in free cash flow and ended the year with almost no net debt, just $5.3 million.
That's a squeaky clean balance sheet. What does $190 million in FCF actually let them do now?
It gives them enormous strategic flexibility. They can self-fund modernization, invest in automation, keep buying back stock and paying dividends, which they did, and they walk into the Terex merger talks from a position of real strength.
But we need to look under the hood. This isn't a one-engine company. It's really a story of two different segments, right?
A tale of two businesses for sure. You have the profit engine, and then you have the part of the business that's fighting some headwinds.
Let's start with the engine. Specialty vehicles. This is the fire trucks, like ambulances.
The incredibly stable, almost utility-like business. Q4 sales, there were $507 million, up over 15%.
That's the margins.
The margins are the highlight. A high watermark of 13.9%, up 220 basis points from last year.
Almost 14% margin in vehicle manufacturing is, it's pretty remarkable. And the visibility they have here is just astounding. That backlog is $4.4 billion.
That backlog is the moat around the whole company. It's supported by, non-cyclical demand from municipalities. They need new fire trucks. Fleets are old. That $4.4 billion translates to roughly 2 years of production.
2 years of revenue is essentially already on the books.
Basically, yeah.
Yeah.
It insulates them from any near-term economic shocks.
I loved the analogy they used on the call about efficiency gains. Even with margins already near 14%, they said they're only in the middle innings of improvements.
Yeah, the 6th or 7th inning, they said. It's a great way of putting it. They're basically saying, we're already winning big, but we see a clear path to run up the score even more.
So more optimization from automation and just simplifying operations.
Exactly. They see more runway.
Okay, let's pivot now to the segment facing the headwinds. Recreational vehicles. You've got this segment with declining backlog and margins under 6%. How does that fit into the turnaround is complete narrative?
That's a great question. And the distinction is that the RV segment's issues aren't internal operational problems anymore. They're purely cyclical demand problems. And that's a very different animal.
So they've cleaned up the manufacturing, but they can't control interest rates.
That's it. Q4 sales were basically flat. The margin ticked up a little to 5.7%, but that was all from disciplined cost cutting, not from soaring demand.
And the dealers are getting cautious.
Very cautious. The segment backlog fell 20%. Management said demand is really mixed. Class C, like their Renegade brand, is actually pretty strong, but the big, expensive Class A models are lumpy, was the word they used.
And what about the Class B van conversions? The script specifically said they were very challenged. Why those in particular?
A couple reasons. First, financing costs are just killing dealers on those units, so they need to offer heavy discounts to move them. Second, they pointed to tariffs. A lot of the chassis and parts are imported, and that just squeezes margins even more when you can't raise prices.
So you have a two-speed company, one segment with a massive moat and huge margins, and another one just trying to manage costs through a downturn.
And if we connect this to the bigger picture, proving they could execute in Q4 was the necessary step before the Terex merger. It frames everything they're doing now.
The combined company is going to be a beast. What's the scale we're talking about?
About $7.8 billion in pro forma sales. And maybe more importantly, a pre-synergy adjusted EBITDA margin of around 11%.
11% before synergies. What's the potential upside there?
They're targeting $75 million in run rate synergies by 2028. And they expect to get about half of that, call it $37.5 million, within the first 12 months of closing.
So that's a guaranteed bump to the bottom line right out of the gate, driven by the same kind of operational focus they used to fix REVG.
That's the plan.
Which brings us back to the market. This all sounds great, but it raises a big question about guidance for next year.
Right. And they explicitly did not issue any formal guidance for fiscal 26 because of the merger. Instead, they're just pointing to the backlog, the current momentum, and those future synergies.
That lack of a concrete number for analysts to model, that can be tricky, especially when a stock has run up over 80% in a year.
It's a fascinating dynamic. You've got this huge run-up, but the average sell-side rating is still just hold.
Why the disconnect? The buy side is clearly voting with their dollars, pushing the stock up.
It's the classic fundamentals versus valuation debate. The analysts are saying, look, the operational story is perfect, but it might already be priced in. They see the merger integration risk and the lack of guidance as reasons to be cautious. They're worried the stock is mathematically expensive right now.
Okay, that sets us up perfectly for our This Is Not Financial Advice segment. So what does this all mean for someone looking for a high conviction, if maybe a little outrageous, trade idea? And a reminder, this is purely for educational purposes.
Okay, so here's the pitch. You've got the strong run, the whole ratings, and a merger that won't close until the first half of 2026. The options market data is showing a put-to-call ratio around 1.5, 1.6.
Let's unpack that. What does that ratio tell us?
It means people are still paying up for downside protection. They're buying more puts insurance against a price drop than they are buying calls to bet on a big spike. The market is, in my view, overestimating the near-term risk.
So you think that fear is misplaced. What's the trade?
The trade is a volatility crush strategy. You have no formal guidance to cause a big surprise, and the next major catalyst is the merger, which is way out in 2026. This creates an environment where the strong operational floor prevents a crash.
But the merger uncertainty puts a ceiling on things.
Exactly. The stock is trapped in a predictable high-level range. So the pitch is to sell out-of-the-money strangles on the nearest quarterly expiration.
So selling both puts and calls, betting the stock stays within a tight band.
That's it. We harvest that premium that's being created by the exaggerated cautiousness in the options market. The operational stability gives us the confidence to make that range-bound bet.
An intriguing way to play a great execution story that's kind of stuck in the merger waiting room. Okay, let's recap the key takeaways.
You've got record free cash flow, a specialty vehicle segment with nearly 14% margins, and a $4.4 billion backlog.
And the transition into a much larger entity through the Terex merger.
The bottom line from this quarter is that they proved they can execute the cleanup, they can generate serious cash. Now, the biggest challenge isn't sales, it's integration.
Right. integrating a $7.8 billion platform while delivering $75 million in synergies.
And managing a soft patch in the RV market at the same time. How they handle those conflicting priorities, integration risk versus cyclical demand, that will define their next chapter.
It's a powerful turnaround story that just became a powerful integration story.
A great quarter and a compelling, if complex, future for REVG.
We appreciate you joining us for this deep dive. We'll see you on the next call.